People think great companies is sufficient and they have these Buffett inevitables, moat company, great company, oh, I just one decision stock. All those things are fine, but they're not great investments unless they are at great price.
You guys were the first ones to come out with a defense thematic basket even before you knew about the defense theme, and that did really well. So how did you visionize this theme?
We had a strategy called...
Very interesting. Yeah, these are some mind-blowing things that you actually told me.
There is a one-day match and there is a test match. And we play the test match. So we have a 5-year horizon. But within last 1.5, 2 years, they went up by 6 or 7.
6 or 7 times.
Just in 1 year.
If I had to ask you of something that you think will unlock very well in India for the next 5 years, what would maybe 2 or 3 themes be?
India is going through what we call the Amrit Kal. There is a very big part. We think all the estimates, including the government estimates, are much lower than what they should be.
If you had to give one advice to the audience, what advice would you give them today?
See, always remember that
Hey guys, in today's episode we have Dr. Vikas Gupta. Now he is the founder of Omniscience. He has studied in IIT Bombay and got his MS and doctorate from New York Columbia University. Now earlier in the past, he used to build quantitative systems and actually help institutions in the US. After that, he started a setup in India called Omniscience Capital, and on small case, they were the first ones to catch the defense theme before it even began. They were also instrumental in catching the railway theme before anyone even heard about it. So in today's episode, obviously I'm curious, so I wanted to ask Mr. Vikas Gupta, how did he catch these themes? What are his framework for identifying these companies, like the screener, and then what does he see as the next theme, because he's very good at finding themes. So today's episode is going to be amazing, so stay tuned and let's enjoy this together. Also, most of you who are watching this are not subscribing to the channel, so if you like it, just click on that subscribe button. And I also want to give a big shout out to Grow, because they have sponsored the channel and we are a part of the Grow network, and because of that we can give such amazing content out to you guys. So if you want to start your investing journey or you want to know more about Grow, you can click on the link in the description below. So hi Vikas ji, first of all, thank you for coming on the podcast and giving me your time. I know you run a very successful fund and small case also. You're very famous called Omniscience, and I know you've done a lot of great things during the small case as well. But first things first, I want to ask you, can you give me your story behind Omniscience?
So we had this core team even before Omniscience. We were working at another firm, and so we decided that we'll get together again and start a new firm. So in 2016 end, or let's say 1st Feb 2017, actually we got incorporated. 3-member team, including me, which are the co-founders. So one quant guy, one me, and one more. So me, Ashwini Shami is the fund manager, and Varun Sood, who's the quant research. And we had been doing a lot of things on systematic alpha generation for a long period of time before this, and putting it on various... it was working extremely well. So it was global, it was Indian. We had we had a good tie-up with NYSE also, and lot of people in the US. So a lot of ETF providers like iShares or BlackRock or Vanguard or
Interesting.
Invesco Power Shares, etc. All of these guys were interested in exploring what we had.
So that was a quant systematic base.
It was very similar to, if you really want to classify, it would be smart beta was hot that time.
Got it.
In US, and everyone was doing beta. What we did is we generated alpha. And how we generated alpha is we tested this against all the, pharma French 3-factor model, 4-factor model and all that. And we still had alpha. So despite the size effect, despite the value effect, despite the momentum or whatever, it was not correlated to that, and there was alpha generation. It was significant. Like when you talk about these smart beta guys, they have 0.5%, 1%,
Correct.
1.5%, maybe 2% in US markets. And our strategy, we had a strategy called Uber Twin. So,
Nice.
and that time Uber was not famous, so it's not borrowed from that. It is like Super Twin, right? Uber Twin. Uber is super in German. So we had taken the same stocks as the S&P 500, but in a different proportion. So normally S&P 500 is market cap weighted, right? Free float market. We had it overweight on the undervalued portion of S&P 500 or the top 500 and underweight on the overvalued portion of S&P 500. That's all. And we had all the 500 stocks and we still had around 5% alpha.
5%. Oh, because the
5%.
cycle was changing from lower to under.
We were
Churning
changing
all.
when it gets overvalued, you sell it and, underweight it and increase the weight of the stuff, undervalued stuff. So that generated 500. So which is crazy. Yeah. So that's why there was huge interest. But anyway, we said we'll come get together and form under a new umbrella. That's how we founded this in Feb 2017. We got a license around May or June, same year. And then we launched our strategies. So we started with the IA license, investment advisory. Then we got a RA. And now we just got a PMS as well. Yeah. Yet to be launched, but just
Got the license.
yeah, yesterday or day before.
Oh, wow. Congrats.
Yeah, thanks.
Yeah. So that's how Omniscience was formed.
Yeah.
So how did you enter the world of small case and how did your thesis get built? Like what investment framework? Because what you did, you can't use it here.
Correct.
And it's very different of what you have done.
Absolutely. Yeah, so that was very institutional, like the earlier whole story which I told you about smart alpha, not beta, right? Smart alpha, smart beta, all that is very institutional stuff. While in India, we were launching with IA, so it was all HNIs and clients to begin with. So this won't work. So we obviously transferred the framework to actual stock picking. So instead of all the 500, or in Indian case, it would be like Uber 50. We had a Uber 50, Nifty 50, right? But instead of that, we'll be choosing stocks. And then why would I restrict to the top 50 or 100? And we were choosing from the top 1,000 crore plus.
Okay, 1,000 crore plus.
Yeah. We said 1,000 plus because below 1,000, the data transparency becomes very, very, very few stocks, very few companies give that kind of information which you want.
Correct.
Everyone else just gives you what is the bare essentials. And that is not sufficient many times. And you're always worried whether what is disclosed and now I'll have to go and visit the plant and is there a plant at all or is there a corporate headquarter at all, right? So I don't want to deal with that. You have around 1,500 companies above roughly 1,000 crores, right? Depending on market levels, the 1,000 crore cutoff will give different companies. But even 1,000 is a lot of companies. 1,500 is definitely, when we started, it used to be 700-800. Now it's like 1,500 companies above 1,000 crores. So it's a very large pool. And that majority of them are small caps by definition, right? Top 100 is large cap, next 150 is mid caps. Everything else is small cap. Yeah. In India, so primarily it's a small cap market, you can say. But these are not small companies, right? It's just a classification. 1,000 crore plus market cap, it's a significant company. It has at least a national presence. And many of them are actually global leaders. Interestingly, those small caps are like the largest market share or the top 3 players in the world in whatever they're producing, right? There are a lot of such companies in India. So anyway, so we pick from that using what we call the scientific investing framework. And of course, when I can pick from such a large universe and I can create a focused portfolio, then what I expect the alpha is much higher, right? Automatically compared to what I was talking about earlier. Anyway, so scientific investing framework and our whole philosophy is science of alpha from safety.
Okay, risk adjusted alpha.
Science of alpha from safety.
From safety.
When everyone is in the market, they all talk about returns.
Correct.
We say return is a given. Because Sensex, look at where Sensex was in 1979, April, it was 100. Today, the real Sensex is more than 100,000. What we see is the Sensex price return. The real Sensex, which includes dividends, is total return index. That's more than 100,000. So it's 1,000 times in 46 odd years. 1,000 times is crazy, right? And that you had to do nothing. You had to just sit on Sensex and you would be 1,000 times. If you did alpha generation, imagine where you would be. So we say money will be made. But most people, they come at the peak of bubble. They come with haphazard knowledge of various things. Some technical, some fundamental, some news driven, something. And they put all of that mishmash together, do some margin trading or FNO, or even they might buy and lose money. And then they will say, you lose money in the stock market. It's like gambling, it's this, it's that.
Correct.
And every cycle you will get new people in at the bubble peak and
Same cycle
lose
keep
them
going.
in the bear market.
Yeah.
So that's why we focus on safety. Our job is, if you don't lose money and you are 5 years or 10 years in the market, Sensex has already done your job. Right?
Yeah.
Even if you don't know anything at all. So forget alpha generation, forget everything. Rule number 1, don't lose capital. Rule number 2, don't forget rule number 1.
Yeah.
Right?
Yeah.
So that's where we are starting from. And we say, how will you lose money? So that is the question. How will you lose money? And that's the first part. Like if you forget listed stocks, all that. Just think of a business. How will it lose money? Lose capital. It will lose capital if it has got huge leverage. If you have a lot of leverage, then you could go bankrupt and then shareholder is completely wiped out. So we don't want that. If a company doesn't have any borrowings, can it go bankrupt? Cannot. So that's the first job. That no leverage or low leverage. What is manageable, right, for that business? Anything above that, and there are a lot of such companies in the market. You don't want them. Simple. We call them capital destroyers because shareholder is going to get completely, his capital is going to get destroyed if the bad thing happens. So we remove all such companies, highly leveraged, consistently loss making. And there are a lot of companies like that. You'll be surprised, but it's there. Or consistently negative cash flows.
That's important, yes.
Right? So all these three things, if they are true, we call them capital destroyers. We throw them out. Now imagine 1,500 companies. I have thrown out around 6 to 700 by now, just in this step. And if I invested in the remaining, let's say there was a Nifty 1,500 and we threw out these 7 and we are remaining with the Nifty 1,500 minus
Yeah.
capital destroyers. You already have alpha
Of course, because you're already removing the bad guys out.
and you already have safety, right? This
Correct.
is clearly fundamentally safer.
Correct.
And it has alpha because in next 5, 7, 10 years, 60 or 70 of those 600 or 700 companies will go completely bankrupt.
Correct.
We don't have them in their portfolio. So our loss is that much less and our gain is that much more. So lower risk, higher return. This is just the first step. Now from the remaining companies, there are companies which maybe were great companies at some point, but today they don't have any competitive advantage. They're just struggling on price, whatever the customer says they have to pay, whatever the supplier says they have to pay, whatever the employees ask they have to pay, right? So they're just surviving somehow. So their return on capital is reflecting that. And they would actually be better off just closing all of that, taking the capital out, putting it in SBI FDs, and they would make more money, right? Without the headache. But still they are listed. Still people can invest in them and we could invest in them. And then we would just be slowly eroded because we should make some return on capital for the cost of capital to compensate at least for that. And this is below that. So even though actually it looks like a profit-making business, they actually pay income taxes. They might have cash flows as well, but it's a very bad business. The longer you stay, you're just losing money. So these we call capital eroders. Let's say few hundred more are out. Now what is left? We think these are all good to great companies. They're at least good because the balance sheet is strong. They have some competitive advantage. Right? So at least good. But if they're great or if they're good and popular, most of the people know about them. Most of the market is there. Mr. Market is not dumb. It's very smart. And they get discovered and their price goes up. Right? So if their price is at such a high level, at some price, even the greatest company is not a great investment. People think great companies is sufficient, and they have these Buffett inevitables and all those kind of ideas, right? Moat company, great company, I just one decision stock. All those things are fine, but they're not great investments unless they are at great price. At the wrong price, it can be a very, very bad situation, a money losing situation. and people have experienced. We've been writing about this or talking about this for more than 10 years. 2014 onwards, I remember at least 3 articles in different media, ETO, Mint, or Money Control, or all those places I've written at intervals of few years. But recently, people have experienced those quality stocks. Like 5-year return is zero, some of the popular names. So people have now realizing, but again, they will say, no, there was an idiosyncratic factor. There's some competition came in, this happened, that happened. They're not willing to understand that you overpaid.
Yeah.
What would prick the bubble will be different for each company.
Correct.
But you don't buy a company in a bubble. So this third bit is where we differ from most other fundamental investors.
Interesting.
And most people who think they're Buffett-like.
Hmm.
This is where we completely disagree with them, or our portfolio looks different from them. So all these great companies, if they're not at the great price, they're not in our portfolio. And then people say there is nothing left. But that's not true. So we take these capital imploders out as well. So these are lot of favorites, darlings of the market. But that is gone. What is remaining is already now 3 layers higher in terms of safety and 3 layers higher in terms of alpha. You could invest in like 100 odd companies here. This would be around 80 to 120 companies typically, right? Now from this finally, we start looking at saying, okay, now we have to do our fund manager's job. Safety is done. Now can we do something more on the returns side, right? And that's when we go company by company. And we ideally like growth companies. It's not like I will not touch a non-growing company. Sometimes it can be an asset play and all, but that is an exception, right? The typical playbook you're asking, and that is what I want to explain, is typically you're looking for growth, historical growth, as well as expected future growth. Because historical growth is already past. That just proves that the company is in a growing, potentially, possibly in a growing, exposed to a growth factor. But it could also be because of a blip like COVID. So if I was making sanitizer, or I was making like all that, I would get a nice blip for a few years, and then that would not be going on, right? So we don't want that. But when you look at historical, you're mixed up with all of that. So you have to now go balance sheet by balance sheet, company announcement by, strategies and all that, and try to understand that what is their strategy? Do they even know why they're growing? Are they exposed to some what we call growth factors? A lot of other people call themes. And is that giving them the growth rate? And if that is giving, are they aware? If they are aware, do they have a good strategy? If they have a good strategy, do we agree with that this will help them grow with the growth factor? If all of this is true, pricing, balance sheet, all that is already taken care of, right? The balance sheet has strong resources, is already given. So they can capture that growth factor, whatever capex is required, right? But do they have a strategy? Everything else, pricing, everything is fine. If they have, then it comes into the portfolio. And typically we want around 5 to 7 such different growth factors. And each growth factor again has many industries. So typically the difference between this and a sector is that growth factor could overlap several sectors. Sometimes it could be in a single sector, but many times it will overlap across. And so you have diversification at stock level, you have diversification at industry sector level, and at the growth factor level. And what we have seen is that roughly, so we have around 25 minimum stocks. Sometimes it goes up to as high as 40. And we've seen like typically, like if my growth factors are to work out in around 3-year time frame, then every 6 months on an average, something will work out independent of the others. Of course, during a bear market, rarely any of them will work out. During bull market, more of them will happen, and so on. But we have an example where even during bear market, it was...
So I want to know this because in your small case, I think you guys were the first ones to come out with a defense thematic basket even before anyone or even knew about the defense theme,
Correct.
you had a defense basket, the Omni
Correct.
defense one,
Correct.
and that did really, really well.
Correct.
Now, you have your filters that you have filtered,
Right.
But defense was not great before the boom of defense. So how did you like visualize this theme in India?
Right. So that time nobody used to write reports on defense and so on. But see, as I mentioned, so we went
Correct.
through this process, and then the last one, the growth vector discovery, right? So when we looked at these companies, what we found out is that PSU hai, this is very bad, all that kind of stuff was going on. But to us, it was very clear from the balance sheet that for last several years, these things had been growing at 10, 15, 20, or even 30%. Such high growth rates. And very strong balance sheets. Forget very strong. I mean, 50% of some of these companies, 30 to 50% of their market cap was in cash, net cash, without any liabilities. Of course, they had to deliver the projects, right? But there was no borrowings per se. And they were available, if I adjust for the cash and all, they are available at single digit Ps. So you have, and you had, if I adjusted for the cash again, then otherwise the ROE looks bad, right? And you think, these are badly run companies, state-owned companies, labor unions, probably nobody works. All true. Despite all of that happening, half the workforce probably not working, they were delivering this kind of growth. They had huge order books. And there was, if I adjusted the return on capital to the operating capital, right? Otherwise, you just take with the cash and everything, it will look small. But if I take out the cash, because that is not being used for the business per se, it's more of an advance, right? To encourage you to go ahead. The ROEs were also extremely good. So capital efficiency is there, high growth rate is there, balance sheet strength is there, order book is there. So I have visibility for future. And the biggest visibility was not here. Why? It was a growth factor. So one thing is we found one company, then we found second, third, fourth, fifth, right? So we found 6 or 7 such companies, number one. And that's why it told us that there is something more here. And then we saw the DPEP, draft a defense promotion and export promotion. I don't remember the full form. DPEP 2020. So it was a defense production and export plan kind of a thing for the next 5 years. And that said that by 2025 we want to do domestic defense production of 1,75,000 crores, and we want to do 35,000 crores of export. These were the numbers given. Compared to where we were importing practically everything.
Yeah.
And these guys were saying we want to indigenize. And we saw all of this bottom up anyway I have shared. But this is the pulling factor which gives us confidence beyond the order book.
Yeah.
That something more is going to happen. But even if it didn't happen, this was good enough
To play.
right? And so we launched this, and it was in our FlexiCap portfolio even before. But October 2020, we launched few on small case. Before that, we were running like only for HNIs, custodian platform, like PMS, but portfolio advisory services. So it's nearly like PMS, but the compliance-wise, whatever changes are required, whatever confirmation we do. So it was in the FlexiCap portfolio, some of the defense stocks, for example. And similar thing we found for railway also.
Okay.
Okay, so railway also, again, we found these companies exactly same. High return on capital. If I adjust for the cash adjusted, it was single digit Ps. Growth rates were all 10, 20, 30% kind of growth rates in the past, as well as huge order books. And again, the National Rail Plan. There was a National Rail Plan 2030, and there was a National Rail Plan 2024. Again, that gave us a lot of confidence that this is part of a bigger strategy. And both these portfolios, we the stocks were there with us from 19 and 20 itself. But on small case, we started in October 2020 with some of the strategies. But these we launched Jan 6th, 2021. Both of these, I remember.
Bullet train and defense.
And then I think 1.5 years, nothing was... means nothing as in it was in line with probably rest of the things happening. And then 22, because of the Fed rate hikes, if you remember, 22 was a bad year, right? And 22, I think defense was the only one performing. The market was flat. Indian market at least recovered. US market was negative, but defense was like 100% up, if I'm not wrong, just 1 year, and so on. So even in a bear market, what I was telling you, this thing
Did really well.
sometimes the growth factor works.
But how, you had that level of conviction that even after the first year, which was barely any performance or in line with the growth rate,
Right.
you didn't feel that, okay, maybe this was wrong or maybe we came in too early or something?
No. See, our process itself, like I said, like we were talking earlier, that there is a T20,
Correct.
there is a one-day match, and there is a test match.
Yeah.
And we play the test match.
So you're okay.
We have a 5-year horizon. And we know that once we enter, it's not going to happen tomorrow. But typically what we have seen is 18 months to 3 years, somewhere some things will start unlocking. But even today I have stocks which I had in 18, and it took 6 years. So in 23, they started unlocking. So all this time, nothing happened. I mean, we were earning huge dividends, 12% like. So nothing. So market return is just coming from dividends. So we are happy with that. But within last 1.5, 2 years, they went up by 6 or 7 times.
6 or 7 times.
Just in 1.5 years.
Oh,
Right?
wow.
And still they're part of the portfolio because still the full
And now your
unlocking
dividend
is not
percentage
there.
will also be very high from your original value.
Absolutely.
Significantly higher.
Yeah. Now the yield is very low.
Yeah. But your
the
original value is very high.
Rupee value of this remains high.
Wow.
And it's still to unlock,
Yes.
according to us.
Yes. And what would be some mistake or some learning that you got while doing this process? Something that you exited early or something like that? Anything?
Yeah. So not in Indian market, but I will say in US market, we run a US portfolio as well. So in US market, like we were quite heavy at one point in retail, right? Because like if you did from the traditional analysis, everything was great. As in the company is strong balance sheet, company has a lot of cash, they have a lot of real estate, right? So market cap is much lower than you add up all these things. And the business is positive cash flow generating. So no debt and all that. But what we found is there's a retail Armageddon happening in US. It's like completely getting destroyed. And all these guys had gone and opened up post the crisis, global financial crisis. They'd opened up so you have A-class malls in the top best places. Then you have B-class malls, slightly outskirts. And they'd gone and opened up C-class malls and it was fine, because when the rents were low and it was all fine. And when the interest rates started increasing, when e-commerce had become stronger and stronger, right? Yeah. And you'll be surprised. I mean, e-commerce was extremely low. We think in US percentage of e-commerce would be very high. Actually, even during COVID, most of the companies we were analyzing, they had hardly 8 or 10% e-commerce. Yeah, it's that low. Total US market is probably 18%.
Oh, India is much higher in that terms.
Way, definitely. So they started feeling that pressure and they started losing. And then you had these lease rentals, which we knew, but you were making positive cash flow. But it never recovered the price because you're continuously announcing every year how many stores you're going to close.
Not open.
So when the growth is not there, cheap thing will remain cheap.
Correct.
And that's where like we now like more growth vectors, right? That whole thing is kind of a learning from that.
So do you apply those philosophies in India as well?
No, absolutely. That's
Because here also we have the store openings going at a very aggressive pace in many companies.
Absolutely. And I don't think that's a great idea to chase.
Yeah. Because I've seen a lot of companies in India doing similar trajectories. And then there is a slowdown and then there is saturation. And then as you said, same store sales growth is usually reducing and your rentals start catching up, and then
Exactly.
that's a cycle to go downwards.
Exactly. And when you have quick commerce competing, right?
Exactly.
Why would you
Exactly.
go
In fact, the
to-
traditional FMCG guys are doing better because of quick commerce, because that percentage revenue has gone up drastically for them.
Right.
Now, about India, let's talk about, let's say, your macro view on India, because you're very good with themes, right? And you played two themes bang on point. Usually, you keep a 5-year time frame. So, if I had to ask you a 5-year time frame from today, something that you think will unlock very well in India for the next 5 years, what would maybe 2 or 3 themes be, or even one theme is fine? What would you think?
So, see, what we have seen is one thing is India is going through what we call the Amrit Kal, right? So, Amrit Kal, the first phase was, getting all the things in line, which is, having the 4G, 5G, then you're having the Aadhaar, then having the mobile, UPI, GST. Now, GST, UPI, all these things created a national marketplace.
Foundation layer.
Right? You could sit in Madurai, order something from Chandigarh, and you could transact. And Flipkart and Amazon were part of that, but also then ONDC from government is also coming. So that's the first part, which is the digital part, phase 1 we call it. It's nearly done. Right? You can look at the UPI transactions. It's mind-boggling. The e-commerce GMVs are mind-boggling. Right? Now the second part of that is how do you deliver from Chandigarh to Madurai? Or from Madurai to Chandigarh, right? That's the second part, which is very weak. We are really bad at that. And the government sources say like 14% of GDP is spent on logistics.
Yeah.
Where the developed countries are like 7% or 8%. So we are extremely inefficient because of the weak infrastructure. So today we are in the second phase. And a lot of infra has already happened, but a lot more will happen in next 5 years.
Yeah, a lot of corridors are being built, or the proposal of corridors are being established.
So that is the next phase of growth. Okay. And there, one of the things is obviously the road infrastructure, railways. Railways you already addressed, right? Defense is part of it in a very broad manner. I mean, you can't be trading internationally if you cannot secure yourself, right? But domestically, roads, railways, power. Okay, so power is a very, very big part. I mean, if your economy is going to grow, then how is it going to get powered? Literally, it's going to power you, right? And we think all the estimates, including the government estimates, are much lower than what they should be. Today, railway is the largest consumer of power in India. Now, if you keep going forward with the electric vehicles, the mandate being 30% by 2030 have to be EVs, right? If you take those numbers and projections, they will become, that will cross railways. The demand for power from EVs.
Just EVs.
EVs, right? Will be better than railways. So that will become the number one. Now, the third thing, we know India produces nearly 10% of the global data. Indian law requires that all the data should be stored here.
In India.
Now, with this kind of a tariff war going on, it's going to be even more stringent now. India will become extremely stringent that everything has to be here. Analysis has to be here. AI idea generation also has to be here, right? AI models also. Now, as soon as you take the AI data centers and you imagine them in India, the power demand is unimaginable.
Yeah, and we're seeing this in US, right? Data's coming out.
Even US is underestimating.
Exactly.
Even they don't know how much power they will need. Buying the NVIDIA chips is fine. I mean, this is the real problem, which is why those small nuclear reactor thing is going on. Which India will also have to do. There's no option. So just to give you that idea, one AI chip from NVIDIA, the power it consumes is equal to what an American household consumes in a year.
In a year?
In a year, the same thing this will consume in a year.
One household. Wow.
One house. And they are like at least 10 times bigger consumers than an Indian household. That's the kind of power required. Right? And so data center will become the number one. So these are the top 3 power consumers. And so everyone is underestimating.
And all are growing.
All are growing. We are the largest 100%, nearly 100% electrified railway in the world. All the other large players are not electrified at all. They're 50, 60, 70%, not more than that.
And household consumption is also growing because of urbanization and multiple buildings.
Huge.
Per square feet, electricity consumption has also gone up a lot, right?
Huge, because we are not industrialized yet to the, like our other reports, we have done analysis on what kind of industrialization, what kind of manufacturing output that requires huge power, what kind of services output, like the more and more organized services. And then that's why we are sitting in a place like this, right, which is fully air conditioned, HVAC centrally and all that, which earlier you would be sitting in a regular, a fan and open. And in Bangalore probably it still works. But in Mumbai, it's so the power consumption of households, power consumption of businesses, business service driving it, power consumption of industrialization driving it is huge.
But now this the number of projects that are being initiated now, we see a lot of EPC projects. Companies like big companies are taking some projects as well. How much percentage do you think these projects are to our actual requirement? Let's say in 2030 or 35. Like, are we ready?
No, we are lower.
Lower.
We are lower.
Like X gigawatt we need by 30, and the projects that are coming out, are we even close to the requirement meeting or very far away from it?
No, not very far away.
But we are far.
We are, I mean, there more can come. Much more can come. But we are not like completely off. So like right now, 1.4 trillion, these units are a little bit difficult, but 1.4 TWH I think is what our consumption is. And it will be going up to, by 2035, around 4 trillion plus.
Okay, that's a lot.
Okay, so it's like 3x nearly, 2.5x. So in 10 years. So it's a pretty heavy duty consumption increase. And if we really do the exports, which we target to do like more than 2 trillion and all that, so because we'll be like around 10 trillion economy by 2035. So we just back calculate from that and like say what kind of industrialization. So we just came out with a couple of reports on the power.
Is it available for public or it's
Yeah,
only...
it's available for
Okay, I'll
public.
check this out.
Yeah. So we've just like last month or something. And so these are huge things. And there is huge demand. And as I said, it's underinvested. So there can be more and more capex coming in without any worry. And power should be cheap, right? Power should be cheap so that you can, so power, logistics, right? Because the logistics costs have to be going down, and all the road projects and the other waterways and so on and so forth.
Very interesting. Yeah, these are some mind-blowing things that you actually told me. Yeah, a lot of. If you had to give, let's say, one advice to the audience, because today what is happening, retail audience wants to learn, wants to consume, wants to understand, and you have a lot of conviction and patience, which is difficult for a retail investor to have, honestly. Sure. What advice would you give them today?
So, see, always remember that you're investing in a business. Why should it suddenly matter to you just because it's listed? To look at something else. Like as soon as it's listed, people start looking at the price movement. That I bought it today, by evening, is it plus or minus? By tomorrow, is it like, why should you worry about that? You have to worry about, you're investing in a business. So business will change every quarter at best, right? That's the most frequent data you have is a quarter when you have something. And really speaking, if someone is investing, if the company is doing capex, it will all show up in 3 to 5 years.
Eventually, it will catch up.
Right. So every quarter also to react to the numbers, it doesn't make sense. Right. In quarter on quarter, it's not even in the control of the management. What is in control is if the company already has a market share, it's a leader, it has a moat, right, or competitive advantage over others, like it's number 1 or 2 or 3, whatever it may be. So that is not changing, right? As long as that is not changing significantly, then why should you react to like small changes that it was supposed to have 15% growth, but it had only 13% growth, and its margins were supposed to be 26.3%, and now they came out at 25.2. Oh my God, what happened? Sometimes something bad could happen. I understand that no permanently this new law has come in or something has happened. So we have to spend more and now the margins are eroded permanently. But otherwise, why should you react to those things? or follow the news like daily, First, you analyze the business. You have to have some idea of how to value it. People go by the market P.
Yeah,
Like,
everyone
oh,
does.
this has been trading at this, so it is fine at this. No, then what is the advantage? What are you bringing to the table? Why should you make extra money?
Correct.
If it is
Point.
fair, then you will also make the fair return, which is the nifty return or the market returns, right? Or the
Fair.
discount rate, what we call.
Fair point.
So, or you look at past 5 year PE or 10 year that it's been trading in this, so it's fine. Oh no, it's lower than what it has been trading on average, so it's cheap. No, that's not how it's cheap. You have to know some idea of DCF, right? Now, DCF, of course, you can't carry out in your Excel and everything. That's not for all the retail
But there are tools
investors,
now that does DCF.
right? So you use those tools, have some understanding of DCF idea, and I'll give you some very simple thing. The simplest thing is the terminal value model. You can apply it today itself, right, to a company. Even though it's for the terminal value, when the company's advantages are over and it goes into a slow mode of growth, which is the cash flow. And people don't know what is cash flow. So forget cash flow, use earnings, it's fine. Earnings divided by R minus G. R is the discount rate. So again, don't get confused too much about what discount rate, how do I calculate it. Long-term return of Nifty is 12-13%. You want to use 12, you can use 12. Going forward, it will be slightly lower. You want to use a round figure, you use 10. Right? So whatever is the earnings, divide by 10% minus G. Now this is tricky. Now, of course, G cannot be more than 10%.
G is what? Growth?
G is the growth rate.
Okay.
Right? But once it's in saturation, so you can use 6% or whatever as the growth rate. And cash flow or earnings divided by 10% minus 6%. So this is divided by 4%. If I invert 4%, it is 25. So it's a 25p.
Correct.
So something which is growing at 6% permanently, perpetually, till infinity, which is fine. I think in India, this inflation itself is 4%.
Correct.
The RBI target.
Correct.
Right? So 2% growth rate on top of it is all you are taking. So 6% growth rate, and you are happy with 10% returns, you can pay 25p. Now, this is how you think about a business. Now, sometimes, so you want to make 15%. So instead of 10%, you put 15%. 15 minus 6, so that's 9%. So it's only 11p is justified if you want to make 15%. Right? You won't pay more than 11. So you use this formula, apply it to companies, and see whether sometimes you will get something even cheaper than this. Sometimes you do. And then it's a great buy.
But you have to hold.
And you have to hold. And the G might be, actually for that company might be 15%. Growth rate itself might be 10, 12, 15%. But it's being traded in the market as if it's a 6% grower. And so it's a cheap thing.
So Vikasji, any other example apart from this?
So when I talk about the scientific investing framework and I say I'll remove this, and when I come to the capital imploders, that great companies but overvalued, you'll say nothing will remain.
Correct.
So, but we gave some examples. Now I'll give you the example of the largest company in the world. So this is 2016. Largest company in the world at that time was Apple. Okay. It was trading at 530 billion market cap. It had 230 billion cash.
Wow.
It
50%.
had around 170 billion debt. So net of all that, it was around trading at 360 billion enterprise value, right?
EV.
When you adjust for debt and cash. My numbers might be slightly off here and there, but 360 billion roughly EV. And the PAT, operating profit, was around 50 billion.
Oh,
FCF was even higher.
correct.
Okay, 70. But let's say, FCF is like a normal.
FCF is free cash flow. for
FCF
people,
is
yeah.
free cash flow. So FCF is obviously, if I sell too much and don't restock, then it will be. So we ignored that. But around 50 billion was the thing. And you're selling at 360.
So it's
It's a
almost,
PE of what?
Yeah, nothing, barely anything.
Right? World's largest company. And it's Apple. It's not some random company nobody knows about, like an oil stock or something. This is not that. What was happening? So 2011, Steve Jobs left us. And then for next 5 years, the complaint on the Wall Street view was that there is no new product.
Yeah, even today, most of it do the same thing. But yes.
Right? So no new product. And so where will the growth come from? And so we are pricing it like this. Now this is fine. Now what was OmniView? OmniView was, of course, I mean, Omniscience didn't exist there. That company didn't exist, but my team was there, right? We are all doing the same thing, roughly. What did we see? We saw a company which had an installed base of devices of 1 billion devices. And we know these devices, they have to be replaced every 3 to 5 years. Right. So let's say average of 4 years. So 250 million devices to be replaced every 4 years. That was very, very clear. There's no doubt about it. Which would give you the sustenance on the sales. At least the flat sales without growth, at least the flat sales was a given. So then my flat FCF is given, my flat PAT is given. Now that is itself is good enough. But then let's address where is the growth coming from. So R&D, they were doing roughly 10 billion R&D per year, 8 to 10 billion. And R&D doesn't pay you in the same year, right? R&D works out for next 6 years. So we said, let's take a 5-year average of R&D. So 5-year R&D, if I sum up 10 billion each, that's roughly around 50 billion of R&D. So how do we estimate what will come out of this? So this is about new products and new innovation. What is the closest thing? Closest thing is Silicon Valley. So we looked at the total US venture capital AUM, not just Silicon Valley VCs, all US VCs put together, the AUM was 350 billion. So out of 350 billion, how many unicorns do you expect to come out? So we said roughly, let's say 1,000 unicorns to come out of the whole VC system in next 5 years. So if 350 billion is 1,000 unicorns, what about 50 billion? So 50 is like 15% of the total US VC system is in one company. And you are saying this company is not going to deliver new products. Doesn't make sense at all, right? So this would come out with somewhere around 150 unicorns, right? Compared to 1,000 there, so 150 unicorns here. And we said, fine, if 150 unicorns, which means
150 billion.
150 billion additional, you're paying 360.
Yeah.
Or let's say we are paying full 530,
500.
right? So 530 on top of it, I get 150 here. Second thing, company had announced, and this is known to everyone, company had announced that we will do a 250 billion buyback over next 2 years.
That's even better.
So 50% of your money, 25% each year is going to come from that. And then you have this. It's a no-brainer. So this is it.
Wall Street was mispriced it so much. Is it market forces, like sentiment?
It's sentiment, right?
Sentiment.
It's sentiment. Like one negative report comes, another guy comes, third guy comes, because they were expecting something huge. So it's like what we call growth disappointment.
Analyst
Disappointment or investor disappointment.
Yeah.
Like the people who are chasing it with their 15%, 20%, 25% kind of growth rate expectation. And suddenly the company says, no, we are not going to do that. And then everyone hates it. And let's say then it's going to do 15% growth rate and they all hate it. 12% growth rate, they all hate it. Right? I'm not applying to this argument, but I'm just saying in general, these kind of things happen because there is disappointment by the existing investor. And they're just dumping. And the new group of investors, like for us, it was a value buy, right? And I wrote an article in thestreet.com. It's still there, 2016. And Buffett also bought it around that time. So it's all what I've said is actually documented on the internet. It's still live, So people get disappointed until the new group discovers. So the growth guys have thrown it off. Value guys have not found it yet. And then they start finding it, and then they have to keep finding it and buying it, and then the stalwart guys will come in between, and then.
But do you think this is like a vicious cycle? Because I know companies give guidance, which ideally some companies don't give. Correct. Some companies love to give guidance.
Yes.
Then analysts will put their guidance metrics in their Excel sheet and say target. Okay.
Exactly.
doesn't happen.
Yes.
Now, company would have grown like 15, 16,
Of course.
17% growth is great.
Absolutely.
But maybe they didn't do 20. And
Right.
because of that, the stock price falls 10, 20%.
Absolutely. Or even more.
Yeah,
Could
but
fall.
fundamentally, it
Nothing
is
wrong
doing
with-
good.
Yes.
But do you
yes.
think this is like a cycle? And then the targets revise. Then it becomes, and then again, you're back to that cycle.
Exactly.
And that's happening in India as well now, right?
Huge.
Yeah.
It's happening. And that's why we have that process, right?
Yeah.
Capital imploders. We take them out.
Do you put guidance as a metric there?
No.
Aggressive
don't look
guidance
at
you
guidance.
are okay with?
No, we don't look at guidance.
Don't
at
look
all.
at guidance.
Means analyst guidance. We look at company guidance.
I'm talking about company
Yeah,
guidance.
Company
Promoter
guidance,
says 50% growth rate. Do you check is he performed like that?
Is he performed and on what basis are you saying I will do 50%? Are you doing capex? Are you putting your money where your mouth is? Are you showing me order books? Are you showing me
Execution
new
of
product
order
launches? Then if there is a backing to what you're claiming, that look, I had a small plant, my huge new plant is getting commissioned in next 2.5 years.
Then fine.
Then I can understand that huge capacity is there. And is there huge demand for you? Like I can put up a plant and nobody wants anything from it, right?
Yeah.
So if the demand is there, pent up demand that look, all these customers want it desperately, and I am trying to create supply.
But what is your take on this new breed of promoters that have entered the market in the last 5 years? A lot of IPOs, new promoters have come in who are very nicely giving guidance. I would not say all are giving aggressive or compressive, but what is your take on this? Do you think they're learning that you should be pessimistic, or they're being very overly optimistic sometimes? What do you think is happening, or are they mature enough to understand?
No, many of them might be mature, but I think many of them, because of the new listing excitement and that, you get to come and it's all very exciting to tell analysts that this will happen, that will happen.
Optimistic.
And if you say good things, everyone likes an ambitious promoter, right?
Yeah.
So there's nothing wrong with that. But giving the guidance hard, if it's backed by facts, which you are actually going to do, it is fine. Otherwise, you are going to get disappointed yourself, right?
Yeah.
And eventually they'll learn that let's be more like under promise and over deliver. Right? So they'll learn, some of them.
Okay, so just if I had to summarize everything. So you gave us the idea of your framework, which is a very, very interesting concept because you've removed all the bad well destroyers or corruptors, removed all the junk out and kept the good guys. Then you do proper fundamental analysis in your small universe that you get from all of this.
Exactly.
Then you take a long-term view. Obviously, you do your research, whether it's defense, whether it's strains, or now whether it's power. Right. You do your research and find the best companies that can play out here. Exactly. Then you invest in it because you're a fundamental investor and you don't look at the price too much like how other people look. No. And even if it fluctuates, you're playing the longer game.
Absolutely.
Then you hold for 4-5 years and wait.
Right.
And then things do eventually play out when the cycle turns.
Absolutely.
And this is all very similar to your first theory of S&P 500 where you used to buy the undervalued companies to make your alpha on the opposite side. So everything's actually tied up at the end.
Right.
Wow. So this Vikasji has been great, honestly. I mean, from a learning experience, I think mainly for the audience as well, it has been absolutely superb. So again, I want to thank you for spending this time and teaching us all of these things. And hopefully we learn and we start implementing it and don't lose money or don't lose capital as your rule number 1. And then
not mine, Warren Buffett.
Warren Buffett. And the rule number 2 is don't forget rule number 1.
Yes.
Yeah. So thank you, Vikasji. So guys, I hope you enjoyed today's video. And I know it was awesome because we had a lot of information from different sources and different angles. But again, if you like this video, click on that like button. And again, I want to thank our sponsor for today's video, which is Grow, because we are a part of Grow Network and they have been instrumental in us growing as a channel, building this systems, creating my research team and giving you as much information as possible. So if you want to start your investing journey or you want to know more about Grow, you can click on the link in the description below and I will see you guys soon.